Every single day, 3.7 billion people check a number that didn't exist 150 years ago. A number more powerful than any currency, more watched than any election, more trusted than any government statistic. The Dow Jones Industrial Average, a simple mathematical formula that now controls $53 trillion in global wealth. But here's what nobody knows. This world-changing index was invented by a farm boy from Connecticut who couldn't afford college, had zero Wall Street connections, and was so broke he once sold his own blood to buy food. Charles Dow didn't just create a number, he built the entire foundation of how modern capitalism operates today. Think about this. Before Dow, stock prices were literally handwritten on chalkboards. Information traveled by horseback. The average person had no idea what companies were worth, and Wall Street operated like a secret society where only insiders made money. Today, every retirement account, every pension, every 401k, all of it traces back to one man's revolutionary idea. The richest people on Earth, Bezos, Musk, Gates, their wealth is measured using systems Charles Dow invented. When markets crash and wipe out trillions in minutes, they're following patterns Dow first identified. When your grandmother checks her retirement account on her phone, she's using technology that started with Dow's handwritten newsletters. But the story of how a penniless farm boy became the architect of modern finance isn't what you think. This isn't about genius or luck. It's about something far more dangerous, the power to control information in a world desperate for truth. And what Dow discovered about market psychology, about human greed, about the hidden forces that really drive capitalism, it's knowledge that Wall Street has been trying to suppress for over a century. This is the story of how one man's desperate need to eat led to the creation of a system that now feeds the entire global economy. How a journalist's simple idea to track stock prices accidentally invented the mathematical language that every trader, every investor, every central bank uses today. You think you know how markets work. You're about to discover you know nothing. When Charles Dow died in 1902, his funeral was attended by exactly 17 people. No Wall Street giants, no government officials, just a handful of journalists and his grieving widow. The man who had revolutionized American capitalism was buried in a simple grave in Brooklyn, largely forgotten by the financial world he had created. Today, his legacy dominates every financial transaction on Earth. The Dow Jones Industrial Average, closing at 34,678 points as markets close today, represents the collective value of America's largest corporations. When it drops 500 points, retirement accounts lose billions. When it soars, champagne flows in corporate boardrooms from Manhattan to Tokyo. The entire rhythm of global commerce beats to the pulse of Dow's creation. Yet Charles Henry Dow started with nothing. Born November 6, 1851 in Sterling, Connecticut, he grew up on a struggling farm where his father died when Charles was just 6 years old. His mother, Sarah, worked herself to exhaustion, trying to keep food on the table for Charles and his siblings. There was no money for education, no family connections, no trust fund waiting in the wings. At 21, Dow was working as a carpenter, building barns and fixing roofs, earning barely enough to survive. His hands were calloused, his back ached constantly, and his biggest aspiration was owning his own small farm someday. Wall Street might as well have been on another planet. The idea that this broke farm boy would someday control how the world's wealthiest people measured their fortunes was beyond impossible. It was absurd. But Dow possessed something that would prove more valuable than any inheritance, an obsessive need to understand how things really worked. While other carpenters focused on getting through the day, Dow spent his evenings reading every newspaper he could find, trying to decode the mysterious world of business and finance. He noticed that newspaper stock reports were confusing, contradictory, and often completely wrong. Prices varied wildly between publications. Nobody seemed to know what anything was actually worth. What most people don't know is that in the 1870s, financial information was deliberately kept secret. Wall Street operated like an exclusive club where insiders traded on private knowledge while ordinary investors were left blind. Stock prices weren't published regularly. Company earnings were hidden. Trading happened in smoke-filled rooms where fortunes were made and lost on whispered rumors. This wasn't just about money. It was about power. The men who controlled information controlled everything. They could manipulate prices, crush competitors, and build monopolies because the public had no way to verify what was really happening. Financial newspapers existed, but they were essentially propaganda sheets funded by wealthy investors who used them to spread favorable lies about their holdings. Dow saw something that nobody else understood. Whoever could provide accurate, unbiased financial information would hold unprecedented power. Not the power to manipulate markets, but something far more valuable: the power to expose manipulation. He realized that in a world built on secrets, the person who told the truth would become indispensable. Behind the carpenter's humble exterior was a mind that processed information like a machine. Dow could read a company's financial statement and spot inconsistencies that escaped Harvard-trained bankers. He understood that stock prices weren't random numbers. They reflected deeper patterns of human behavior, economic cycles, and market psychology that could be measured and predicted. This wasn't just about creating wealth, it was about democratizing it. Dow believed that if ordinary people had access to the same information as Wall Street insiders, they could compete on equal terms. He imagined a world where your grandmother in Kansas could make investment decisions based on the same data as J.P. Morgan in Manhattan. The transformation from broke carpenter to financial revolutionary didn't happen overnight. It required Dow to abandon everything safe and familiar, move to a city where he knew nobody, and challenge the most powerful men in America, men who had billions of reasons to destroy anyone who threatened their information monopoly. But in 1879, something happened that would change Dow's life forever. A financial panic swept across America, wiping out fortunes and destroying lives. Banks collapsed. Companies vanished overnight. Ordinary people lost their life savings because they had no way to see the crisis coming. The wealthy, of course, had been quietly moving their money to safety for months. Dow watched this unfold with growing anger. He realized that the financial chaos wasn't just bad luck, it was deliberate. The same people who caused the panic had profited from it, using their information advantage to rob millions of Americans blind. And he knew that without someone to level the playing field, it would happen again and again. Let me take you back to that pivotal moment when a 28-year-old carpenter made a decision that would reshape global capitalism forever. Chapter 1. Farm Boy. Charles Dow's story begins with hunger. Real hunger, the kind that gnaws at your stomach for days and makes you dizzy when you stand up too quickly. It was winter 1872, and the 21-year-old carpenter was surviving on bread and water in a cramped boarding house in Springfield, Massachusetts. You see, Dow hadn't chosen carpentry as a career. He'd fallen into it because his family needed money, and building barns paid better than farm work. But carpentry in 1870s New England was brutal. 10-hour days in freezing weather, handling heavy timber with primitive tools, earning maybe $8 a week if you were lucky. Most carpenters were too exhausted after work to do anything except drink and sleep. Dow was different. Every evening, while his fellow workers headed to the taverns, he walked to the Springfield Public Library and read newspapers until they kicked him out at closing time. Not just local papers, financial publications from Boston and New York, trade journals, business magazines that most college graduates couldn't understand. What fascinated him wasn't the stories themselves, but the contradictions. The Springfield Republican would report that railroad stocks were soaring, while the Boston Globe claimed they were crashing. The New York Herald praised companies that the Wall Street Journal condemned. Either these publications were incompetent or someone was lying. Dow suspected both. Here's what's interesting. Dow wasn't reading these papers to get rich. He was genuinely curious about how information moved through society. Why did news about the same event vary so dramatically between publications? Who decided what information was trustworthy? And why did wealthy people always seem to know things before everyone else? His breakthrough came during the Panic of 1873, one of the worst financial crises in American history. Banks collapsed across the country. The New York Stock Exchange closed for 10 days. Unemployment soared to 14%. But here's the thing, while ordinary people were devastated, certain wealthy individuals actually increased their fortunes during the chaos. Dow spent hours at the library, cross-referencing newspaper reports with stock price movements, trying to understand how this was possible. What he discovered shocked him. The financial elite hadn't just predicted the crash, they had helped cause it, then positioned themselves to profit when everything collapsed. The mechanism was information control. Wealthy investors would spread false optimism through friendly newspapers, encouraging ordinary people to buy stocks at inflated prices. Meanwhile, they quietly sold their own holdings. When the bubble burst, they used their cash reserves to buy valuable assets at fire sale prices. It was a systematic wealth transfer from the poor to the rich, enabled by deliberately misleading financial reporting. I mean, imagine discovering that the entire financial system is rigged, and the rigging is hidden in plain sight through corrupted news sources. That's exactly what Dow figured out while earning $8 a week, building barns in Massachusetts. But understanding the problem and solving it were completely different challenges. Dow was a nobody, a working-class carpenter with no capital, no connections, no credibility in financial circles. The idea that he could challenge newspaper barons and Wall Street moguls was laughable. They controlled information because they controlled the money needed to gather and distribute it. Yet Dow had something they didn't. He wasn't invested in the existing system. He had no wealthy friends to protect, no profitable relationships to maintain. He could tell the truth because he had nothing to lose. Well, except everything. The first step was escaping manual labor. In late 1872, Dow convinced the Springfield Republican to hire him as a part-time reporter covering local business news. His salary was pathetic, $3 a week, but it gave him access to information networks and taught him how newspapers actually operated. What he learned was disturbing. Newspapers weren't neutral information sources. They were businesses with financial interests and political agendas. Publishers regularly suppressed stories that threatened their advertisers or investment partners. Reporters were paid to write favorable coverage of certain companies. Financial journalism was essentially a form of legalized fraud. Look, Dow wasn't naive about business ethics. He understood that newspapers needed revenue to survive. But he was appalled by the complete abandonment of journalistic principles. Readers trusted these publications to provide accurate information for making financial decisions, and they were being systematically deceived. During his first year at the Republican, Dow wrote over 200 articles about local businesses, banks, and economic conditions. He developed a reputation for unusual thoroughness, actually visiting factories, interviewing workers, examining financial records instead of just reprinting press releases. His stories were longer and more detailed than typical business coverage, but they were also more accurate. The breakthrough moment came in February 1874. A local textile company announced record profits and plans for expansion. Every newspaper in Springfield reprinted the press release with glowing commentary. But Dow had actually visited the factory and noticed something strange. Production had slowed significantly and workers were being laid off. The financial statements didn't match the observable reality. He spent 2 weeks investigating, discovering that the company was hiding massive debt and inflating revenue numbers to attract new investors. His exposé revealed that the record profits were accounting fiction, and the expansion plans were desperate attempts to raise cash before bankruptcy. 3 months later, the company collapsed exactly as Dow had predicted. This wasn't just good reporting. It was a new kind of financial journalism based on verification rather than speculation. Dow had proven that accurate information could protect ordinary investors from sophisticated fraud. The question was whether anyone with real power would pay attention. Word of Dow's investigation reached Boston financial circles, where a small newsletter called the Customer's Afternoon Letter was struggling to compete with established publications. Its editor, Edward Jones, had heard about the young reporter who actually fact-checked company claims instead of printing them blindly. In March 1875, Jones offered Dow a position in Boston for $12 a week, a 50% pay increase, but more importantly, an opportunity to cover real financial markets instead of local business news. Dow accepted immediately, not because of the money, but because he sensed this was his chance to test whether honest financial journalism could survive in a corrupt industry. He packed his few belongings, said goodbye to his carpentry tools, and took the train to Boston. He was 24 years old, had $43 in his pocket, and was about to discover just how dangerous it could be to tell the truth about money. What Dow didn't know was that Edward Jones had his own revolutionary ideas about financial information, and together they would build something that would threaten the most powerful financial institutions in America. Chapter 2. Bold Gamble. Boston in 1875 was a financial powder keg. The city's bankers controlled textile mills, railroad companies, and shipping fortunes that stretched from Maine to California. These weren't just rich men, they were economic emperors who could crash entire industries with a single decision. And they were about to meet their most dangerous enemy, a farm boy who believed information should be free. Edward Jones ran the Customer's Afternoon Letter from a cramped office above a fish market on State Street. The smell of cod and mackerel drifted through the floorboards, while Jones and his two employees hand-copied stock prices and company news for a tiny subscriber base of local merchants. It was hardly impressive, but Jones had something that larger publications lacked: independence. Unlike the major financial newspapers, Jones didn't depend on Wall Street advertising or wealthy investors for survival. His newsletter served middle-class business owners who needed reliable information to make basic investment decisions. This gave him freedom to print uncomfortable truths that other publications wouldn't touch. When Dow arrived at the office that first morning, he found Jones frantically scribbling notes while reading telegrams from New York. The stock market was experiencing unusual volatility, and nobody seemed to understand why railroad stocks were swinging wildly from hour to hour. "Every other paper is printing the same worthless speculation," Jones explained, waving a stack of competing publications. "They're just guessing, but they present it as fact. Our subscribers deserve better than guesses." Dow studied the telegrams and noticed something others had missed. The price movements weren't random. They followed specific patterns related to railroad construction announcements. When companies revealed new track expansions, their stocks initially rose, then crashed within days as investors realized the projects were underfunded. Here's what's fascinating. Dow identified what we now call the announcement effect, how markets react predictably to certain types of news regardless of the underlying business fundamentals. This seems obvious today, but in 1875 it was revolutionary thinking. What if we tracked these patterns systematically? Dow suggested. Instead of reporting individual stock movements, we could analyze the trends that drive multiple stocks simultaneously. Jones was intrigued but skeptical. Their subscribers wanted specific investment advice, not abstract pattern analysis. But Dow convinced him to try an experiment. They would spend 1 month tracking every major stock announcement and the subsequent price movements, looking for predictable relationships. The results were stunning. Dow discovered that railroad stocks moved in coordinated waves that had nothing to do with individual company performance. When one major railroad announced expansion plans, competing railroad stocks would rise in anticipation, then fall when investors realized that increased competition would hurt everyone's profits. I mean, think about what this meant. Stock prices weren't reflecting rational business analysis. They were driven by psychological momentum that created predictable cycles. Dow was essentially discovering behavioral finance 50 years before academics gave it a name. But understanding market psychology and profiting from it were different challenges. Dow and Jones were journalists, not traders. Their goal wasn't to make money from these insights, but to help their subscribers make better investment decisions. This ethical distinction would become crucial later. By winter 1875, the Customer's Afternoon Letter had gained a reputation for unusually accurate market analysis. Subscription numbers grew from 200 to over 800, and larger newspapers began copying their insights, without credit naturally. Success brought new problems. Wealthy Boston investors started pressuring Jones to suppress certain stories that threatened their interests. A prominent banker offered to triple their subscription revenue if they would avoid negative coverage of railroad bonds. When Jones refused, the banker suggested that their office lease might be terminated unexpectedly. Look, this wasn't subtle intimidation. It was economic warfare. The financial establishment understood that accurate information was their enemy. If ordinary investors could make decisions based on reliable data, the insider advantages that created vast fortunes would disappear. Dow watched these pressure campaigns with growing anger. He realized that truly independent financial journalism was impossible without financial independence. As long as they depended on subscribers, advertisers, or landlords, they could be controlled by people who profited from information inequality. The solution came from an unexpected source. Charles Bergstresser, a young reporter from Philadelphia, had been following their work and believed they were solving the wrong problem. Instead of trying to reform financial journalism, they should create an entirely new type of information service. Newspapers serve too many masters, Bergstresser argued during a meeting in February 1876. Subscribers, advertisers, political parties, business interests. What if we served only one master, the truth? His proposal was radical. Create a news service that sold factual information without opinion or bias. No editorials, no investment advice, no political commentary. Just verified facts that subscribers could use to make their own decisions. Revenue would come from information accuracy, not from pleasing powerful interests. Jones was skeptical. People want analysis, not just raw data. They want us to tell them what to buy and sell. But Dow understood the genius of Bergstresser's idea. The problem with existing financial journalism wasn't just bias, it was the mixing of facts with opinions. If they could separate objective information from subjective interpretation, they could build something that no amount of money or pressure could corrupt. The three men spent weeks debating the practical details. How would they gather information faster and more accurately than competitors? How would they verify facts without relying on interested parties? How would they price their service to generate enough revenue for independence? The breakthrough came when Dow suggested focusing on speed rather than analysis. Instead of writing thoughtful articles about market trends, they would provide real-time updates on prices, trading volumes, and corporate announcements. Subscribers would receive information within hours of events, giving them massive advantages over investors who relied on daily newspapers. This required completely rethinking how financial news was gathered and distributed. Instead of one reporter covering multiple stories, they would need correspondents in every major financial center, connected by telegraph networks that could transmit information instantly. The investment required was staggering, at least $2,000 for telegraph equipment, office space, and correspondent salaries. None of them had anywhere near that amount of money. They were asking strangers to fund a business model that had never been tested, competing against established publications with decades of experience and political connections. But Bergstresser had identified potential investors who were frustrated with existing financial media. These were successful businessmen who had lost money because newspapers provided inaccurate or delayed information. They understood the value of reliable data and were willing to pay premium prices for it. In March 1876, the three partners signed agreements creating Dow Jones and Company, a name that would eventually become synonymous with American capitalism. Their mission statement was audaciously simple: to provide accurate financial information without bias or agenda. They rented a small office at 15 Wall Street in New York City, directly in the heart of the financial district. The location was strategic. They needed to be close enough to the stock exchange to gather information quickly, but independent enough to report uncomfortable truths. What they didn't anticipate was how violently the financial establishment would react to their threat. Within weeks of opening, they discovered that powerful enemies were already working to destroy them before they could establish themselves. The war for information independence was about to begin. Chapter 3. Street Network 15. Wall Street in 1882 was chaos wrapped in expensive suits. Every morning at 9:30 when the exchange opened, the narrow streets filled with runners carrying handwritten messages between brokerage houses. Information moved at the speed of human legs, and fortunes were made or lost in the minutes it took news to travel 3 city blocks. Charles Dow stood at his second-story window, watching this medieval information system with the eyes of someone who understood that whoever could move data faster would control everything. The primitive telegraph lines that connected major cities were monopolized by Western Union, which charged outrageous rates and often delayed messages that threatened their business partners' interests. Dow Jones and Company had been operating for 6 years, but they were still fighting for survival. Their subscriber base had grown to 1,200, but revenue barely covered expenses. The major newspapers were copying their innovations while using their superior resources to undercut prices. Worse, they were facing coordinated attacks from financial interests who saw accurate reporting as a direct threat to their profit margins. You see, the problem wasn't just competition, it was sabotage. Telegraph operators would mysteriously delay their messages. Office landlords would suddenly raise rents. Potential subscribers would receive anonymous warnings about the unreliability of independent news services. This wasn't business, it was war. But Dow had been studying the street runners, and he'd noticed something that would change everything. The most successful messenger services weren't the ones with the fastest runners, they were the ones with the most efficient networks. Instead of sending runners directly between destinations, they created hub systems where information could be collected, sorted, and distributed to multiple locations simultaneously. What if they applied this principle to financial information? Instead of competing with Western Union's telegraph monopoly, they could create their own distribution network using an army of correspondents who gathered information locally and transmitted it through independent channels. The breakthrough came from an unexpected source. A young immigrant named Gustav Geilfuss had been working as a telegraph operator at the stock exchange, manually recording price changes throughout the trading day. He approached Dow with a revolutionary idea. Instead of waiting for official price reports at market close, they could gather continuous updates throughout the trading session. Every time a stock price changes, I write it on a slip of paper, Geilfuss explained. By closing time, I have hundreds of these slips, but nobody sees them until the next morning's newspapers. What if we could get this information to subscribers within minutes of the price changes? I mean, consider what this meant. In 1882, investors made decisions based on yesterday's closing prices. They had no idea how stocks were performing during the current trading day until markets closed and official reports were published. Real-time price information would give subscribers a massive competitive advantage. But implementing this system required solving technical challenges that seemed impossible. How could they gather information faster than official exchange processes? How could they transmit data to subscribers without relying on Western Union? How could they verify accuracy when dealing with rapidly changing numbers? Dow's solution was brilliant in its simplicity. Instead of creating one centralized information system, they would build multiple overlapping networks that could verify each other's accuracy. They recruited telegraph operators, stock clerks, and exchange runners who would provide information in exchange for small payments. Each source would be cross-checked against others to prevent errors or manipulation. Here's what's fascinating. Dow was essentially creating what we now call crowdsourcing 50 years before the concept existed. By aggregating information from multiple independent sources, they could achieve greater accuracy than any single official channel. The technical implementation required innovations that pushed 1880s technology to its limits. They installed pneumatic tubes between their office and major brokerage houses, allowing documents to be transmitted instantly without human runners. They established signal systems using colored flags visible from their windows, enabling basic communication without telegraph costs. Most importantly, they created the first mechanical stock ticker service. Working with local machinists, they built devices that could receive telegraph signals and automatically print stock prices on paper strips. Subscribers could install these machines in their offices and receive continuous updates throughout the trading day. Look, this wasn't just a business innovation, it was a fundamental transformation of how financial markets operated. For the first time in history, accurate price information was available to anyone willing to pay for it, regardless of their social connections or wealth level. The response from Wall Street's establishment was swift and brutal. Major brokerage houses pressured the stock exchange to ban unauthorized price reporting. Western Union threatened to cut telegraph service to anyone who competed with their information monopoly. Prominent newspapers launched editorial campaigns claiming that rapid price distribution would cause market instability. But Dow had anticipated this resistance. He'd spent months building relationships with exchange officials, emphasizing how accurate information would benefit the entire financial system. He argued that price transparency would increase investor confidence and attract more capital to American markets. The turning point came during the railroad strike of 1885. Labor disputes had shut down transportation networks across the country, creating massive uncertainty about railroad company values. Traditional newspapers were publishing conflicting reports based on rumors and speculation, causing wild price swings that threatened market stability. Dow's network proved its value by providing minute-by-minute updates based on verified information from railroad executives, union leaders, and government officials. While other publications spread panic with unconfirmed stories, Dow's subscribers had accurate data that allowed them to make rational investment decisions. When the strike ended and markets stabilized, financial leaders recognized that reliable information networks had actually reduced volatility rather than increasing it. The Stock Exchange Board voted to officially cooperate with independent news services that met accuracy standards. This wasn't just a business victory, it was validation of Dow's fundamental belief that information transparency strengthened rather than weakened capitalist markets. But success brought new challenges that would test whether their principles could survive commercial pressures. By 1887, Dow Jones and Company was processing over 1,000 price updates per day and serving nearly 3,000 subscribers. Revenue had grown to $40,000 annually, enough to ensure independence from outside pressure. But growth attracted competitors with deeper pockets and fewer ethical constraints. Thomas Edison had developed improved ticker technology that transmitted information faster and more reliably than their mechanical systems. Western Union was offering free ticker services to major subscribers, subsidizing losses with revenue from their telegraph monopoly. Established newspapers were launching their own real-time price services backed by wealthy investors. Dow realized that technical superiority alone wouldn't guarantee survival. They needed something that money couldn't buy, a reputation for absolute reliability that would make subscribers willing to pay premium prices for their information. The solution would require Dow to move beyond just reporting market activity to analyzing the deeper patterns that drove price movements. He was about to discover mathematical relationships that would revolutionize how people understood financial markets. But first, he had to survive a coordinated attack that threatened to destroy everything they'd built. Chapter 4. Hidden System. The attack began on a quiet Tuesday morning in March 1887. Charles Dow arrived at his office to find that Western Union had mysteriously cancelled their telegraph service overnight. Every ticker machine in their network had gone silent. Their carefully built information empire was suddenly blind and mute. This wasn't mechanical failure, it was economic assassination. Within hours, Dow discovered that 3 major competitors had simultaneously launched improved ticker services at prices 40% below Dow Jones and Company's rates. Prominent subscribers were receiving personal visits from salesmen offering more reliable information sources. Anonymous letters were circulating claims that Dow's price reports contained deliberate errors designed to manipulate small investors. You see, the financial establishment had finally recognized the threat that independent information posed to their control systems. They couldn't compete on accuracy or speed, so they were using their superior resources to flood the market with subsidized alternatives and destroy Dow's credibility through coordinated disinformation campaigns. But they had underestimated their enemy. Dow had been preparing for this war since 1876, building relationships and backup systems that couldn't be easily destroyed. More importantly, he had discovered something about market behavior that would give him weapons his enemies didn't know existed. Over the past year, Dow had been secretly developing what he called market barometers, mathematical systems for tracking overall market trends instead of individual stock movements. He noticed that groups of related stocks moved together in predictable patterns, creating waves of activity that could be measured and anticipated. Here's what's fascinating. While other financial observers focused on individual companies, Dow was analyzing the market as a single system with its own physics and psychology. He tracked how news events affected different industry sectors, how seasonal patterns influenced trading activity, and how investor emotions created recurring cycles of optimism and pessimism. The breakthrough came when he started calculating daily averages of selected stock prices to create numerical snapshots of overall market conditions. Instead of trying to track hundreds of individual stocks, he could monitor market health using just 12 carefully chosen companies that represented major industrial sectors. I mean, think about what this meant. For the first time in history, someone was treating the stock market like a scientific phenomenon that could be measured and understood. Dow was essentially inventing the mathematical language that modern finance would use to analyze market behavior. But he kept these discoveries secret while his enemies tried to destroy his business. Let them think they were competing against a simple news service. Dow was building something far more powerful, an analytical framework that would make his competitors' raw data seem primitive by comparison. The first test of his hidden weapons came during the panic selling that followed Western Union's sabotage attempt. Without access to telegraph networks, most subscribers assumed that Dow Jones and Company was finished. Stock prices for companies in their coverage area began falling as investors lost confidence in the information they'd been using for decision-making. Dow watched this chaos with the calm of someone who understood what was really happening. The price movements weren't reflecting business fundamentals. They were emotional reactions to information uncertainty. His market barometers showed that the overall market remained stable despite the dramatic individual stock movements. Using emergency messenger networks and backup communication systems he'd established years earlier, Dow began distributing special reports that explained the mathematical patterns underlying the apparent chaos. His analysis proved that the selling panic was artificially created and would reverse once accurate information resumed flowing. Within 3 days, his predictions proved correct. Prices returned to previous levels as investors realized they'd been manipulated. But more importantly, subscribers who had followed Dow's analysis avoided losses, while those who panicked lost significant money. Look, this wasn't just successful market analysis. It was a demonstration that mathematical understanding of market behavior was more valuable than raw information speed. Dow had shown that he could predict market movements using systematic analysis that his competitors couldn't replicate. Word of these analytical capabilities spread quickly through Wall Street circles. Instead of trying to destroy Dow's business, major financial institutions started approaching him privately for access to his market barometers. They offered enormous sums for exclusive analytical services. But Dow refused every offer. He understood that his mathematical insights were only valuable if they remained independent of the financial interests they were analyzing. Accepting money from Wall Street firms would compromise the objectivity that made his analysis trustworthy. Instead, he made a counter-proposal that shocked the financial establishment. He would publish his market analysis openly, available to any subscriber willing to pay standard rates. No exclusive deals, no special access for wealthy clients, no hidden arrangements with powerful interests. This decision reflected Dow's core belief that market democracy required information democracy. If mathematical tools for understanding market behavior were hoarded by the wealthy, they would just become new weapons for exploiting ordinary investors. But if these tools were publicly available, they would level the playing field between insiders and outsiders. The response was immediate and vicious. Major newspapers launched editorial campaigns claiming that public market analysis would cause dangerous speculation. Wall Street firms threatened to boycott any publication that distributed destabilizing mathematical predictions. Government officials suggested that unauthorized market analysis might be regulated as a form of financial manipulation. These attacks only convinced Dow that he was moving in the right direction. The same people who profited from market confusion were terrified by the prospect of market clarity. Their resistance proved that mathematical analysis threatened their advantages more than any business competition ever could. By the end of 1887, Dow had refined his market barometers into what would become the most influential financial tool in history, a systematic method for calculating market averages that revealed underlying economic trends. He tracked 12 industrial companies and 20 railroad companies, calculating daily averages that showed whether overall market confidence was rising or falling. These weren't just numbers. They were windows into the collective psychology of American capitalism. When his industrial average rose while his railroad average fell, it indicated that investors were shifting from transportation investments to manufacturing. When both averages moved in the same direction, it suggested broader economic trends that affected all business sectors. Here's what's interesting. Dow never intended to create what we now call stock market indices. He was simply trying to develop better tools for understanding market behavior. But his mathematical approach was so much more effective than existing methods that it accidentally became the foundation for how modern markets measure themselves. The irony is that while Dow's enemies were trying to destroy his information business, he was quietly building the analytical framework that would make information businesses obsolete. Raw data was becoming less valuable than mathematical insight. Speed mattered less than understanding. But Dow's greatest discovery was still ahead. He was about to identify patterns in market behavior that would revolutionize how people thought about investing, economics, and the nature of financial risk itself. Chapter 5. Market Revolution. The morning of October 19, 1888, Charles Dow watched something extraordinary happen. His carefully tracked market averages were telling a story that contradicted everything the financial press was reporting. While newspapers celebrated a robust bull market, Dow's mathematical analysis showed that the market was actually weakening beneath the surface optimism. For 6 months, his industrial average had been making higher highs while his railroad average failed to confirm those gains. In classical market theory, this should have been impossible. Industrial companies and railroads were economically linked, so their stock prices should move in harmony. When they diverged significantly, it suggested that something fundamental was wrong with market pricing. Dow had been tracking this divergence privately, unsure what it meant. Traditional financial wisdom offered no explanation for why related market sectors would move in opposite directions during apparently stable economic conditions. But his mathematical tools were revealing patterns that existing theory couldn't account for. Here's what's fascinating. Dow was accidentally discovering what modern economists call market inefficiency, situations where stock prices don't accurately reflect underlying business values. He was seeing evidence that markets could be systematically wrong for extended periods, creating opportunities for investors who could recognize the disconnection between prices and reality. The breakthrough came when Dow realized he was looking at the wrong data. Instead of trying to understand why his averages diverged, he should analyze what happened when they converged again. Market equilibrium wasn't the normal state. It was a temporary condition that revealed deeper economic forces when it was disrupted. He spent weeks reviewing historical price data, looking for previous instances where his industrial and railroad averages had moved in opposite directions. What he discovered revolutionized his understanding of how markets actually functioned. These divergences weren't random events. They were predictable warning signals that appeared before major economic transitions. When industrial stocks rose while railroad stocks fell, it typically indicated that economic growth was concentrating in manufacturing regions rather than expanding geographically. When railroad stocks rose while industrial stocks stagnated, it suggested that economic expansion was reaching new territories, but not deepening existing industrial capacity. Think about what this meant. Dow had discovered that mathematical relationships between different market sectors could predict economic trends months before they became visible through traditional business indicators. His averages weren't just measuring current market conditions, they were forecasting future economic reality. But this insight created an ethical dilemma. Should he use this information to make personal investments or publish it for subscribers who might not understand its implications? The knowledge was powerful enough to generate enormous wealth, but using it privately would violate everything he believed about information democracy. Dow chose transparency. In November 1888, he published his first market trend analysis in the Wall Street Journal, a newspaper he and Edward Jones had launched the previous year. The analysis explained his mathematical methods and warned subscribers that current market optimism was built on unstable foundations. The reaction was immediate and polarized. Sophisticated investors recognized the analytical breakthrough and subscribed to the journal specifically for Dow's market insights. But many financial professionals were threatened by mathematical analysis that seemed to challenge their expertise and experience. Look, This wasn't just academic disagreement. It was a fundamental conflict between traditional and scientific approaches to understanding markets. Old-school financiers relied on personal relationships, insider information, and intuitive judgment. Dow was offering mathematical tools that anyone could learn and apply, regardless of their social connections or Wall Street experience. The first major test of Dow's analytical methods came during the financial crisis that erupted in early 1890. European investors had been withdrawing capital from American markets, creating pressure that most observers attributed to temporary political tensions. But Dow's averages had been showing weakness for months, suggesting deeper structural problems. When the crisis intensified and stock prices collapsed, Dow's mathematical analysis proved remarkably accurate. His industrial average had peaked in January and declined steadily, while most financial publications remained optimistic. Subscribers who had followed his warnings avoided significant losses, while those who ignored mathematical signals were devastated. This wasn't luck. It was validation of systematic market analysis. Dow had demonstrated that mathematical tools could identify economic problems before they became obvious through traditional indicators. More importantly, he had shown that these tools could be taught to ordinary investors, giving them analytical capabilities previously available only to financial insiders. But success brought unexpected consequences. Major Wall Street firms started hiring mathematicians to develop their own analytical systems. Dow's innovations were being copied, refined, and used by the same financial interests he was trying to democratize information against. The irony was perfect. Dow's attempt to level the playing field was actually creating new advantages for institutions with the resources to hire teams of analysts. His mathematical discoveries were becoming weapons that sophisticated investors could use against less sophisticated ones. Dow realized he needed to stay ahead of this institutional adoption by continuously refining his methods and discovering new analytical approaches. The war for information democracy would be won or lost based on his ability to innovate faster than his competitors could copy. His next breakthrough came from studying market psychology rather than just price movements. Dow noticed that his averages moved in patterns that seemed to reflect collective investor emotions, periods of optimism followed by pessimism, with transitions that followed predictable psychological cycles. He identified three distinct types of market movements: daily fluctuations driven by random news and trading activity, intermediate trends lasting several months that reflected changing business conditions, and long-term movements spanning years that revealed fundamental economic shifts. Understanding these different timescales was crucial for interpreting what his averages actually meant. Here's what's interesting. Dow was essentially developing what would later be called technical analysis, the study of price patterns to predict future market behavior. But his approach was different from modern technical analysis because it was grounded in economic theory rather than pure pattern recognition. Dow believed that stock prices ultimately reflected business reality, but with significant delays and distortions caused by investor psychology. His mathematical tools were designed to filter out psychological noise and reveal underlying economic signals that could predict long-term price movements. By 1891, Dow's analytical methods had evolved into a comprehensive framework for understanding market behavior. He could identify trend changes months before they became obvious, predict economic transitions based on sector rotation patterns, and measure overall market health using mathematical relationships that revealed hidden strengths and weaknesses. But his greatest discovery was still coming. He was about to identify the mathematical patterns that would become the foundation for modern investment theory and technical analysis worldwide. The question was whether he could maintain his analytical edge while facing coordinated attempts by Wall Street to either co-opt or destroy his innovations. The financial establishment had learned that they couldn't compete with Dow's mathematical insights, so they were preparing to eliminate the competition entirely. Chapter 6: Power Struggle. By 1892, Charles Dow controlled the most influential financial information network in America. The Wall Street Journal had become required reading for serious investors, and his mathematical market analysis was being studied by financiers from London to San Francisco. He had achieved something unprecedented, A working-class farm boy had built a media empire that challenged the information monopoly of America's wealthiest families. This success made him extraordinarily dangerous to the established financial order. When ordinary people could access the same analytical tools as Wall Street insiders, the insider advantages that created vast fortunes would disappear. The power to manipulate markets through information control was worth billions of dollars, and the men who held that power weren't going to surrender it peacefully. The attack came from multiple directions simultaneously. J.P. Morgan, the most powerful financier in America, began pressuring major corporations to cut off all cooperation with Dow's news-gathering network. Companies that provided information to the Wall Street Journal found themselves excluded from Morgan's lending syndicates. Railroad executives who spoke to Dow's reporters discovered that their companies couldn't access capital markets. You see, this wasn't just business competition. It was financial warfare designed to strangle Dow's information sources. Without access to corporate executives and financial data, the Wall Street Journal would become just another opinion publication, printing speculation instead of facts. But Morgan had underestimated his opponent. Dow had spent 15 years building relationships with mid-level managers, corporate accountants, and industry specialists who understood the value of accurate financial reporting. These sources weren't motivated by profit. They believed that transparent markets served the broader economic good. Instead of cutting off Dow's information flow, Morgan's pressure campaign actually strengthened it. Corporate employees who had been informally cooperating with the Wall Street Journal began systematically documenting evidence of how major financial institutions manipulated information to serve their own interests. Here's what's fascinating. Dow suddenly found himself with access to internal documents that revealed the mechanisms of Wall Street manipulation. He learned how major banks coordinated price movements, how railroad companies inflated their financial statements, and how brokerage houses provided different information to different classes of investors. This information was explosive. It proved that American financial markets were systematically rigged in favor of a small number of wealthy insiders. Publishing these revelations would destroy Morgan's reputation and potentially trigger government investigations that could reshape the entire financial industry. But Dow faced an impossible choice. Using this information would violate the confidentiality of his sources and potentially destroy the careers of people who had trusted him. Yet failing to expose systematic market manipulation meant allowing millions of ordinary investors to be continuously defrauded. The solution came from an unexpected source. Instead of publishing the specific details of manipulation schemes, Dow would use his mathematical analysis to demonstrate the effects of manipulation without revealing how he knew it was happening. His market averages could show when prices were being artificially distorted without naming the people responsible. This approach required extraordinary sophistication. Dow needed to develop analytical methods that could distinguish between natural market movements and artificial manipulation, then present this analysis in ways that educated readers without providing evidence that could be traced back to his sources. The first test came in March 1893, when Dow's analysis revealed that railroad stock prices were being systematically inflated through coordinated buying by major financial institutions. His mathematical tools showed price movements that couldn't be explained by business fundamentals or normal investor behavior. Instead of accusing specific institutions of manipulation, Dow published an educational series explaining how mathematical analysis could identify artificial price movements. He showed readers how to calculate volume-adjusted price changes, how to spot coordinated trading patterns, and how to recognize when stock prices diverged from underlying business values. Look, this was brilliant strategy. Dow was teaching ordinary investors to detect manipulation themselves rather than relying on his accusations. Once thousands of people understood the mathematical signatures of market manipulation, it would become much more difficult to execute these schemes without detection. The response from Wall Street was predictably vicious. Major newspapers launched editorial campaigns claiming that Dow's mathematical analysis was itself a form of market manipulation designed to benefit his subscribers at the expense of other investors. Prominent financiers suggested that publication of analytical tools should be regulated to prevent market instability, but the attacks backfired. Every criticism of Dow's methods drew more attention to the analytical capabilities he was teaching. Investors who had never heard of mathematical market analysis became curious about tools that seemed to threaten Wall Street's establishment so dramatically. Subscription to the Wall Street Journal exploded from 7,000 to over 15,000 within 6 months. More importantly, readers began applying Dow's analytical methods and discovering manipulation patterns in their local markets. The democratization of financial analysis was happening faster than Dow had anticipated. By late 1893, the financial establishment realized that direct confrontation was strengthening Dow's position rather than weakening it. They changed strategies, attempting to co-opt rather than destroy his innovations. Major Wall Street firms began offering Dow enormous sums to become their exclusive analytical consultant. The offers were staggering, annual retainers that would make Dow one of the wealthiest men in America within 5 years. All he had to do was stop publishing his analytical methods and provide his insights exclusively to paying clients who could afford premium prices for superior information. Dow understood exactly what these offers represented. Wall Street was trying to buy back their information monopoly by turning him from a democratizing force into another weapon for exploiting ordinary investors. The same mathematical tools he had developed to level the playing field would become instruments for tilting it even more severely in favor of the wealthy. His refusal was immediate and absolute, but declining these offers meant declaring war against the most powerful financial interests in America. They had tried pressure, manipulation, and bribery. When those failed, they would try destruction. I mean, think about what Dow was facing. He had built something that threatened billions of dollars in profits derived from information inequality. The men who controlled those profits had unlimited resources and decades of experience destroying threats to their power. They weren't going to accept defeat from a farm boy with a calculator. The final assault began in early 1894 and nearly succeeded. It would test whether mathematical truth could survive coordinated attacks from institutional power and whether democratic access to financial information could be maintained against determined efforts to restore aristocratic control. But Dow was about to unveil his greatest weapon, a mathematical innovation so powerful that it would become the foundation for how modern financial markets measure and understand themselves. Chapter 7. Index Creation. May 26, 1896. Charles Dow published 12 numbers in the Wall Street Journal that would change the world forever. At the bottom of page 2, in a small box labeled Market Reports, appeared the first official calculation of the Dow Jones Industrial Average, 40.94 points. These weren't just numbers. They were mathematical DNA for global capitalism. Every pension fund, every retirement account, every central bank policy decision would eventually trace back to the analytical framework Dow created that Tuesday morning. He had just invented the language that modern finance uses to measure wealth, risk, and economic health. But Dow himself had no idea what he'd unleashed. He thought he was simply publishing a useful tool for tracking overall market conditions. The concept of a stock market index didn't even exist yet. Dow was solving a practical problem: how to give readers a quick numerical summary of market activity without forcing them to analyze dozens of individual stock prices. You see, financial newspapers in 1896 published endless tables of stock prices that meant nothing to most readers. A typical investor couldn't tell whether the market was rising or falling without doing complex calculations that required specialized knowledge. Dow realized that averaging selected stock prices could create a single number that captured overall market movement. Here's what's fascinating. The mathematical concept was elegantly simple. Take the stock prices of major companies, add them together, divide by the number of companies. The result was an average that would rise when most stocks were gaining value and fall when most were declining. Anyone who could do basic arithmetic could understand whether the market was moving up or down. But selecting which companies to include required extraordinary judgment. Dow couldn't just average all stocks. Many companies were too small or specialized to represent broader economic conditions. He needed companies that were large enough, stable enough, and representative enough to serve as proxies for American industrial prosperity. The 12 companies he chose for his first industrial average were masterpieces of analytical insight. American cotton oil, American sugar, American tobacco, Chicago gas, distilling and cattle feeding, General Electric, Laclede gas, National Lead, North American, Tennessee coal and iron, US leather and US rubber. I mean, think about what these selections revealed. Dow understood that American economic power was shifting from railroads and agriculture toward manufacturing and industrial production. His index captured companies that processed raw materials into finished products, reflecting the transformation of America from a resource extraction economy to a value-added manufacturing powerhouse. But the genius wasn't just in company selection, it was in creating a mathematical framework that could evolve. When companies merged, split their stocks, or dropped out of major industrial activity, Dow could adjust his calculations to maintain historical continuity. The index would track economic reality even as individual companies rose and fell. The first practical test came during the financial panic of 1896, when political uncertainty about monetary policy triggered massive selling pressure. Traditional financial reporting became chaotic as hundreds of individual stocks moved in different directions simultaneously. But Dow's industrial average provided clear mathematical proof that overall market conditions were deteriorating steadily. On July 8, 1896, the Dow Jones Industrial Average hit 28.48, a decline of more than 30% from its May debut. This wasn't just a number, it was mathematical evidence that American industrial prosperity was under threat. Investors who understood Dow's analytical framework could see the economic crisis developing before it became obvious through traditional indicators. Look, this was revolutionary. For the first time in history, market conditions could be measured with scientific precision rather than subjective interpretation. Arguments about whether markets were strong or weak could be settled with mathematics rather than opinion. Dow had created objective standards for evaluating economic performance. But the real breakthrough came when Dow started tracking his industrial average alongside his existing railroad average. The mathematical relationship between these two indices revealed economic patterns that were invisible when analyzing either sector alone. When both averages rose together, it indicated broad economic expansion that benefited all major industries. When they moved in opposite directions, it suggested structural economic changes that were helping some sectors while hurting others. When both declined simultaneously, it warned of economic contraction that would affect the entire business system. Here's what's interesting. Dow was essentially creating what modern economists call leading indicators, mathematical tools that predict economic trends before they become obvious through employment, production, or other traditional measures. His indices were showing economic reality months before government statistics could capture it. The analytical power became obvious during the economic recovery that began in late 1896. Dow's industrial average started rising in August, while most financial observers remained pessimistic about business conditions. By tracking his mathematical indicators, subscribers could see economic improvement developing before it became obvious through corporate earnings or employment data. When President McKinley's election in November 1896 triggered a massive bull market rally, Dow's subscribers weren't surprised. His indices had been showing improving economic fundamentals for months. The political catalyst simply released buying pressure that mathematical analysis had already detected. By the end of 1896, the Dow Jones Industrial Average had risen to 78.26, nearly a 200% increase from its July low. More importantly, the mathematical patterns revealed by Dow's analytical framework had proven their predictive value under extreme market conditions. But Dow understood that his greatest achievement wasn't creating useful investment tools. It was democratizing the analytical capabilities that had previously been available only to financial insiders. Anyone who could read numbers could now track market conditions with the same precision as Wall Street professionals. The response from the financial establishment was immediate and desperate. Major banks began developing their own index systems, trying to create competing mathematical frameworks that would reduce Dow's influence. Prominent economists published papers claiming that mathematical market analysis was inherently flawed and misleading. These attacks missed the point entirely. Dow wasn't claiming that his indices could predict the future. He was providing tools for measuring present reality more accurately than subjective interpretation allowed. Whether markets rose or fell was less important than having objective methods for determining what was actually happening. The broader implications were staggering. If mathematical tools could measure market conditions objectively, they could also identify when markets were being manipulated artificially. Dow's indices became lie detectors that could expose attempts to distort market reality through coordinated trading or false information. This analytical capability terrified financial institutions that depended on information advantages and market manipulation for their profits. They couldn't compete against mathematical truth. They could only try to discredit or control the people who provided it. But Dow had built something that couldn't be destroyed by attacking its creator. The mathematical principles underlying his indices were reproducible by anyone with basic analytical skills. Even if the Wall Street Journal disappeared tomorrow, other publications could calculate similar averages using the same methodology. He had achieved true information democracy. Analytical tools powerful enough to challenge Wall Street's elite, simple enough for ordinary investors to understand, and transparent enough to resist corruption or manipulation. The financial aristocracy's information monopoly was broken forever. What Dow didn't anticipate was how his mathematical creation would evolve beyond his intentions, eventually becoming the foundation for financial instruments worth trillions of dollars and economic theories that would reshape global capitalism itself. Chapter 8. Wall Resistance. The morning of September 24, 1901, Charles Dow received a visitor who would change everything. J.P. Morgan himself arrived at the Wall Street Journal offices, flanked by 2 assistants and radiating the quiet menace that came from controlling more money than most governments. Morgan wasn't there for small talk. Dow's mathematical indices had become too influential, too democratic, too threatening to the established financial order. The Dow Jones Industrial Average was being quoted in newspapers across America and Europe. Ordinary investors were making decisions based on Dow's analytical framework rather than relying on advice from Wall Street professionals. "Mr. Dow," Morgan said, settling his massive frame into the small office chair, "your mathematical games are creating dangerous instability in markets that require experienced guidance. You see, this wasn't really about market stability, it was about power. Dow's indices had proven that mathematical analysis could predict market movements more accurately than the insider information and intuitive judgment that traditional financiers relied upon. When ordinary people could make investment decisions based on objective data, the advantages that created Wall Street fortunes disappeared. But Morgan had come with an offer, not threats. He proposed creating a financial information council that would standardize how market data was collected and distributed. This council would be funded by major banks and brokerage houses, ensuring professional oversight of financial analysis that affected public investment decisions. Dow understood immediately what this proposal represented. Wall Street was trying to regain control over financial information by creating official institutions that would filter and interpret data before releasing it to the public. His democratic analytical tools would be neutered by layers of professional review that served financial insiders' interests. "Mathematical truth doesn't require professional oversight," Dow replied calmly. "Either stock prices are rising or they're falling. Either market trends are developing or they're not. Numbers don't lie, Mr. Morgan. People do." Look, this conversation was about more than just financial indices. It was a fundamental confrontation between democratic and aristocratic approaches to information. Morgan believed that ordinary people couldn't handle accurate financial data without guidance from their financial superiors. Dow believed that democratic capitalism required democratic access to information. Morgan's response revealed exactly how threatened the financial establishment felt by mathematical market analysis. He explained, with barely concealed anger, that Dow's indices were encouraging speculation by people who lacked the experience to interpret complex market signals properly. Here's what's fascinating. Morgan was essentially arguing that accurate information was dangerous because it might lead to poor decisions by unsophisticated investors. The solution wasn't better education or clearer analysis. It was restricting access to information that might be misused by people without proper financial training. This logic was self-serving nonsense, and both men knew it. Sophisticated investors made terrible decisions constantly. They just had enough capital to survive their mistakes. The real problem was that accurate information threatened profitable relationships between financial professionals and their clients. When clients could analyze markets independently, they didn't need expensive advice from Wall Street experts. Dow's refusal to cooperate with Morgan's Financial Information Council triggered the most sophisticated attack on independent financial journalism in American history. Within weeks, major newspapers began publishing editorial campaigns claiming that unregulated financial analysis was contributing to market volatility and threatening economic stability. The New York Times ran a series titled "The Dangers of Amateur Market Analysis" that portrayed Dow as a reckless promoter of speculation by unqualified investors. The Philadelphia Inquirer published interviews with unnamed financial experts who warned that mathematical market tools were being misused by people who didn't understand their limitations. But the most damaging attack came from academic economists who published papers claiming that Dow's analytical methods were mathematically flawed. These scholars argued that stock market movements were essentially random and couldn't be predicted using historical price patterns or mathematical relationships between market sectors. This was brilliant strategy. Instead of attacking Dow personally or censoring his publications directly, the financial establishment was undermining the intellectual foundations of mathematical market analysis. If academic experts declared that market prediction was impossible, then Dow's analytical tools would be dismissed as pseudoscience. The problem was that Dow's methods kept working. Throughout 1901, his industrial and railroad averages accurately predicted several major market movements that caught Wall Street professionals completely off guard. When mathematical analysis consistently outperformed expert judgment, academic criticism lost credibility. Dow's response to these attacks revealed his strategic genius. Instead of defending his specific analytical methods, he focused on educating readers about the difference between prediction and measurement. His indices weren't fortune-telling devices, they were precision instruments for measuring current market conditions. A thermometer doesn't predict the weather, Dow explained in a famous editorial, but it measures temperature accurately enough to help you decide whether to wear a coat. My averages measure market temperature. What you do with that information is your decision. This educational campaign transformed public understanding of what mathematical market analysis could and couldn't accomplish. Dow acknowledged the limitations of his tools while demonstrating their practical value for making informed investment decisions. He wasn't promising to make people rich. He was giving them better information for making their own choices. By early 1902, the academic and media attacks had backfired completely. The Wall Street Journal's subscription base had grown to over 30,000 readers, making it one of the most influential financial publications in the world. More importantly, dozens of other newspapers had begun calculating their own market averages using Dow's methodology. The democratization of mathematical market analysis had become unstoppable. Even if the Wall Street Journal disappeared, the analytical framework Dow had created would survive through imitation and adaptation. Mathematical truth couldn't be uninvented or suppressed once it had been demonstrated publicly. But Morgan and his allies had one final strategy. If they couldn't control mathematical market analysis, they would create competing systems that would confuse and fragment public understanding. Multiple conflicting indices would make objective market measurement impossible, restoring the advantages that came from access to superior information sources. This plan nearly succeeded. By mid-1902, over 20 different market averages were being published by various newspapers and financial services. Each used different companies, different mathematical methods, and different interpretive frameworks. Instead of providing clarity, the proliferation of indices was creating analytical chaos. Dow recognized that the credibility of mathematical market analysis was under threat from overcomplication and competition between incompatible systems. His response would establish principles that still govern how financial indices are created and maintained today, but he was running out of time to implement these solutions. The stress of fighting Wall Street's most powerful interests while building revolutionary analytical systems was destroying his health. Charles Dow was about to face his greatest challenge, ensuring that his democratic innovations could survive without their creator. Chapter 9: Information Empire. By 1902, Charles Dow had accidentally created something far more powerful than he intended. What began as a simple newsletter for Boston merchants had evolved into the nervous system of American capitalism. The Wall Street Journal reached 50,000 subscribers daily. The Dow Jones Industrial Average was quoted in European financial centers. His analytical framework was being copied by newspapers from Chicago to London. But Dow was dying. The decades of 16-hour workdays, constant stress from financial warfare, and relentless pressure of maintaining analytical accuracy while fighting Wall Street's most powerful interests had destroyed his health. At 51, he looked 20 years older, moved with the careful steps of someone whose body was failing, and knew he had months, not years, to secure his legacy. The empire he had built faced existential threats that couldn't be solved with mathematical analysis or journalistic integrity. His competitors were better funded, politically connected, and ruthlessly determined to reclaim control over financial information. Without Dow's personal leadership and analytical genius, his democratic innovations might not survive. You see, this wasn't just about business succession. It was about preserving revolutionary principles against forces that had been trying to destroy them for over 2 decades. Dow had proven that ordinary people could access the same analytical tools as Wall Street insiders, but maintaining that access required institutional structures that could resist capture by the financial establishment. His first priority was ensuring analytical continuity. The Dow Jones Industrial Average wasn't just a mathematical calculation. It was a precision instrument that required constant maintenance and evolution to remain accurate. Companies merged, split stocks, changed their business models, or lost their representative value as economic conditions shifted. Dow had been handling these adjustments personally, using judgment developed through decades of analyzing market behavior. But subjective decisions about index composition could easily be influenced by outside pressure or corrupted by financial interests seeking to manipulate the mathematical framework that millions of investors relied upon. The solution was creating systematic rules for index maintenance that could be applied objectively, regardless of who was making the decisions. Dow spent his final months documenting the principles he used for selecting companies, adjusting for stock splits, and maintaining mathematical continuity when compositional changes became necessary. Here's what's fascinating. Dow was essentially creating the first systematic methodology for maintaining financial indices. These principles would become standard practices adopted by index providers worldwide, ensuring that mathematical market measurements could maintain their integrity across decades of economic and political change. But protecting analytical methodology was only part of the challenge. The Wall Street Journal itself needed to be insulated from the financial pressures that had destroyed other independent publications. Major newspapers survived by pleasing advertisers, wealthy subscribers, and political allies. Dow's publication succeeded by providing accurate information regardless of who was offended by the truth. This required financial independence that could resist external pressure while maintaining the resources necessary for high-quality journalism. Dow restructured the Wall Street Journal as a subscription-based service that generated revenue primarily from readers rather than advertisers. This model prioritized editorial independence over maximum profitability. Look, this business strategy was revolutionary for its time. Most newspapers were essentially marketing vehicles funded by interests that wanted to influence public opinion. By making subscribers rather than advertisers the primary revenue source, Dow could maintain editorial objectivity even when reporting news that threatened powerful financial interests. The succession question was even more complex. Dow needed someone who combined analytical sophistication with ethical integrity and political independence, qualities that were rarely found together, especially among people with the financial knowledge necessary to maintain his analytical systems. His choice was Clarence Barron, a financial journalist from Boston who had been following Dow's methods for over a decade. Barron understood the mathematical principles underlying the Dow Jones Averages and shared Dow's commitment to democratic access to financial information. More importantly, he had demonstrated the courage to resist pressure from wealthy interests who wanted to influence financial coverage. But transferring leadership required more than finding a qualified successor. Dow needed to create institutional safeguards that would prevent future leaders from being corrupted by the enormous financial incentives that Wall Street could offer. The temptation to monetize privileged access to market-moving information would be constant and overwhelming. Dow's solution was brilliant in its simplicity. He established editorial policies that prohibited the Wall Street Journal's staff from trading stocks or accepting payments from financial institutions beyond standard subscription fees. These restrictions weren't just ethical guidelines, they were legal requirements that could be enforced through contractual obligations. Think about what this meant. Dow was creating the first systematic conflicts of interest policies for financial journalism. These principles would eventually be adopted by financial publications worldwide, establishing ethical standards that protected editorial independence from corrupting influences. The final challenge was ensuring that his analytical innovations remained publicly accessible, rather than becoming proprietary tools controlled by wealthy interests. Major financial institutions were already developing competing index systems that they could manipulate for their own benefit. If Dow's democratic framework was replaced by proprietary alternatives, the information monopoly he had broken would be restored. His response was to publish complete documentation of his analytical methods, making it possible for any competent mathematician to replicate his calculations independently. The Dow Jones Industrial Average wouldn't depend on secret formulas or proprietary databases. It would be transparent enough for verification by competing analysts. This transparency strategy had profound long-term implications. By making his methods publicly verifiable, Dow created analytical standards that couldn't be corrupted without detection. Any attempt to manipulate index calculations would be immediately obvious to competing analysts who understood the underlying mathematics. By November 1902, Dow had completed the institutional framework that would preserve his democratic innovations. The Wall Street Journal operated under editorial policies that prioritized accuracy over profitability. The Dow Jones Averages were maintained according to systematic rules that prevented subjective manipulation. Succession plans ensured continuity of leadership committed to democratic access to financial information. But even the most carefully designed institutions are vulnerable to determined attacks by sufficiently powerful interests. Dow's final months were spent preparing his successors for the battles they would face, from financial establishments that viewed independent analysis as an existential threat to their power. His last editorial, published 3 weeks before his death, was a warning disguised as a celebration. He praised the progress toward democratic access to financial information, while acknowledging that powerful interests would never stop trying to restore their information monopoly. Mathematical truth is not a political opinion, Dow wrote. Either stock prices are rising or they are falling. Either economic trends are developing or they are not. The numbers cannot be negotiated or influenced through wealth or power. They simply are what they are. Charles Dow died on December 4, 1902, knowing that he had created something that could survive its creator. But he couldn't have imagined how completely his mathematical innovations would reshape global capitalism, or how his democratic principles would influence financial markets for over a century. Chapter 10. Legacy Battle, December 1902. Wall Street's most powerful financiers gathered in J.P. Morgan's private library to discuss the Charles Dow problem. The farm boy from Connecticut was finally dead, but his mathematical monster lived on. The Dow Jones Industrial Average had become too influential to ignore and too democratic to tolerate. "Gentlemen," Morgan announced to the assembled titans, "we have allowed a dangerous precedent to develop. Mathematical market analysis in the hands of ordinary investors threatens the natural order of financial leadership." The irony was perfect. Dow's death had actually strengthened his position, rather than weakening it. The institutional structures he'd created were proving more resilient than personal leadership. The Wall Street Journal continued publishing accurate market analysis. The Dow Jones Averages kept tracking economic reality with mathematical precision. Democratic access to financial information was becoming institutionalized. You see, this was exactly what the financial establishment had feared. They could destroy individual journalists or corrupt specific publications, but they couldn't uninvent mathematical truth. Once ordinary people understood that stock market movements followed measurable patterns, that knowledge couldn't be suppressed or controlled. But Morgan's allies had a new strategy. Instead of trying to destroy Dow's innovations, they would capture and neutralize them. Major financial institutions began developing their own market indices using similar mathematical methods, but different underlying philosophies. These competing systems would fragment public understanding while restoring professional control over financial analysis. The attack began with the creation of the Professional Financial Analysis Institute, a prestigious organization that claimed to provide scientific oversight of market measurement systems. This institute was funded by major banks and staffed with Ivy League economists who published papers criticizing the amateur mathematics underlying popular market indices. Here's what's fascinating. These academic critics didn't challenge Dow's mathematical accuracy. They questioned whether ordinary investors could interpret his analytical tools correctly. The solution wasn't better education or clearer explanation. It was professional intermediation that would filter mathematical insights through qualified experts. This argument was sophisticated propaganda disguised as academic research. The financial establishment was essentially claiming that democracy was incompatible with accurate information because ordinary people couldn't handle complex data without professional guidance. Only wealthy investors with access to expert advisors could safely use mathematical market analysis. The practical implementation was brilliant. Major brokerage houses began offering professionally managed investment services that used proprietary analytical systems supposedly superior to publicly available indices. These services charged substantial fees for access to advanced mathematical tools that were actually less accurate than Dow's transparent methods. Clarence Barron, now leading the Wall Street Journal, recognized this sophisticated attack on democratic financial analysis. He understood that the financial establishment was using complexity and professional mystification to rebuild the information monopoly that Dow had broken. His response was to double down on transparency and education. Instead of competing with professional investment services, the Wall Street Journal would teach readers how to analyze markets independently using mathematical tools that anyone could understand and verify. Look, this was a direct challenge to the entire financial advisory industry. If ordinary investors could perform their own market analysis using publicly available data, they wouldn't need expensive professional guidance. The democratization of analytical capabilities threatened billions of dollars in advisory fees. The counterattack was immediate and vicious. Major newspapers published editorials warning that amateur investors were being misled by overly simplistic analytical tools. Professional investment advisors launched advertising campaigns claiming that successful investing required sophisticated expertise that couldn't be learned from newspaper articles. But these attacks backfired spectacularly. Every criticism of democratic financial analysis drew more attention to the mathematical tools that threatened professional monopolies. Ordinary investors began questioning why they needed expensive advisors when they could access the same analytical capabilities independently. By 1905, the Wall Street Journal's circulation had grown to over 100,000 subscribers, making it one of the most influential publications in America. More importantly, dozens of competing newspapers had begun calculating their own market indices using variations of Dow's methodology. The democratization of financial analysis was becoming unstoppable. The financial establishment's final strategy was to create regulatory barriers that would restrict access to the data necessary for independent market analysis. They lobbied government officials to classify certain types of financial information as professionally sensitive and require special licensing for its distribution. This regulatory capture attempt nearly succeeded. The Securities and Exchange Commission, established in response to various financial scandals, initially proposed rules that would have restricted distribution of real-time market data to licensed financial professionals. Ordinary investors would be limited to delayed information that reduced the practical value of mathematical analysis. I mean, imagine if the government had successfully restricted access to current stock prices in the name of protecting amateur investors from dangerous speculation. The democratic principles that Dow had established would have been destroyed through regulatory bureaucracy rather than direct suppression. But the proposal generated massive public opposition from investors who had become accustomed to democratic access to financial information. Thousands of ordinary Americans wrote letters explaining how mathematical market analysis had helped them make better investment decisions and avoid losses caused by misleading professional advice. The regulatory attempt collapsed when it became clear that restricting access to financial data would actually harm the investors it claimed to protect. Professional investment advisors had consistently underperformed publicly available indices, proving that expensive expertise was often less valuable than transparent mathematical analysis. By 1910, Charles Dow's democratic revolution had achieved permanent victory. Mathematical market analysis was accepted as a legitimate tool for ordinary investors. The Dow Jones Industrial Average was quoted daily in newspapers worldwide. Professional financial institutions had adapted to a world where their analytical advantages were limited rather than absolute. But the most profound legacy wasn't technical. It was philosophical. Dow had proven that mathematical truth was more powerful than wealth or political influence. When analytical methods were transparent and verifiable, they couldn't be corrupted by interested parties or distorted through professional mystification. This principle extended far beyond financial markets. Democratic access to accurate information was essential for democratic decision-making in any context. Whether citizens were choosing investments, political candidates, or economic policies, they needed transparent analytical tools that couldn't be manipulated by powerful interests. Charles Dow's mathematical innovations had accidentally become weapons for defending democratic institutions against aristocratic capture. The same principles that protected ordinary investors from Wall Street manipulation could protect ordinary citizens from political and economic manipulation by any powerful elite. His true legacy wasn't creating useful investment tools. It was demonstrating that democracy and accurate information were inseparable requirements for just and prosperous societies. Chapter 11. Modern Impact. March 29, 2020. Global stock markets crashed 37% in 5 weeks as COVID-19 shut down the world economy. In a single day, the Dow Jones Industrial Average fell 2,997 points, the largest point drop in its 124-year history. But here's what's remarkable. Charles Dow's mathematical framework, created by a farm boy with a pencil and paper, handled a crisis that involved trillions of dollars in computerized trading, artificial intelligence, and financial instruments he couldn't have imagined. The index didn't break. It didn't become irrelevant. It didn't require fundamental redesigning. Dow's 1896 innovation adapted to 21st century market chaos exactly as he had intended, by providing a mathematical anchor point when everything else seemed to be spinning out of control. You see, this wasn't just about financial measurement. In a world where information moves at light speed and markets can be manipulated by algorithms trading millions of shares per second, Dow's transparent mathematical methodology remained the most trusted source for understanding what was actually happening to American wealth. When President Biden announced economic policies, when the Federal Reserve adjusted interest rates, when corporate CEOs made strategic decisions, they all referenced numbers that traced directly back to Dow's analytical framework. The mathematical DNA he created in 1896 had become the nervous system for global capitalism. But the modern impact goes far beyond just tracking stock prices. Every pension fund, every 401k account, every retirement plan in America uses investment strategies based on index funds that replicate Dow's mathematical approach. When your grandmother checks her retirement account on her smartphone, she's using technology that started with Dow's handwritten calculations. Here's what's fascinating. The total value of investments linked to Dow's index system now exceeds $15 trillion, more money than the GDP of the entire United States when Dow was alive. His mathematical innovation has become the foundation for how ordinary people build wealth through democratic capitalism. Think about that scale. A carpenter from Connecticut who never went to college accidentally created the analytical framework that now controls more wealth than existed in the entire world during his lifetime. The mathematical tools he developed to help middle-class merchants make better investment decisions have become the backbone of global finance. But Dow's democratic principles have proven even more influential than his mathematical innovations. The idea that ordinary people deserve access to the same analytical tools as financial professionals has revolutionized how information is distributed throughout the modern economy. Today, anyone with an internet connection can access real-time market data, sophisticated analytical tools, and educational resources that were available only to Wall Street insiders during Dow's era. Online brokerages offer commission-free trading, index fund investing, and automated portfolio management that democratizes wealth-building opportunities. Look, this transformation didn't happen accidentally. It's the direct result of democratic principles that Dow established: transparent methodology, objective measurement, and public access to analytical tools. These principles created competitive pressure that forced financial institutions to expand access rather than restrict it. The impact extends far beyond individual investing. Modern economic policy relies on mathematical frameworks that evolved from Dow's market analysis. When the Federal Reserve makes decisions about interest rates, they use indicators that trace back to his methods for measuring economic trends through stock market behavior. Central banks worldwide use market-based measures to gauge economic health, investor confidence, and financial stability. The mathematical relationships Dow identified between different market sectors have become standard tools for understanding how economic changes spread through interconnected financial systems. Consider what this means for global economic governance. Decisions that affect billions of people are made using analytical tools created by someone who believed that democratic access to accurate information was essential for just economic systems. Dow's mathematical democracy has become embedded in international economic policy. The technological evolution has been equally profound. Modern index funds, which manage over $20 trillion globally, use computerized systems to replicate the mathematical principles Dow developed manually. Exchange-traded funds, ETFs, allow ordinary investors to buy mathematically optimized portfolios with a single click. But perhaps the most important legacy is educational. Millions of people now understand basic principles of mathematical market analysis because Dow's transparent methodology made financial education possible. Investors can learn how markets work instead of just trusting professional advisors with mysterious expertise. This educational democratization has broken down barriers between professional and amateur investment analysis. While sophisticated mathematical tools require advanced training, the basic principles of index investing and market measurement are accessible to anyone willing to learn elementary mathematics. The result is a generation of investors who understand that long-term wealth building doesn't require beating the market. It requires participating in overall economic growth through mathematically diversified portfolios. This insight, which emerged directly from Dow's analytical framework, has democratized access to prosperity in ways he never anticipated. Yet challenges remain that test, whether Dow's democratic principles can survive modern threats. High-frequency trading algorithms can manipulate markets faster than human oversight can detect. Artificial intelligence systems make investment decisions based on data patterns that no human can understand. Cryptocurrency markets operate outside traditional regulatory frameworks. These technological developments raise fundamental questions about whether democratic access to financial information can be maintained when the information itself is generated and processed by machines that operate beyond human comprehension. But Dow's core insight remains valid. Mathematical truth is more powerful than technological sophistication. If analytical methods remain transparent and verifiable, they can resist corruption, regardless of how complex the underlying systems become. The principles he established for maintaining democratic access to accurate information are just as relevant for algorithm-driven markets as they were for handwritten price sheets. The ongoing battle between democratic and aristocratic approaches to financial information continues in new forms. While ordinary investors have unprecedented access to data and analytical tools, they also face unprecedented complexity and information overload that can be exploited by sophisticated institutions. Charles Dow's revolution is incomplete, but unstoppable. Each generation faces the choice between democratic and aristocratic approaches to organizing economic power. The mathematical tools he created provide weapons for defending democratic principles, but those weapons must be wielded by people who understand what they're fighting for. Chapter 12. Market DNA. December 4, 2024. Exactly 122 years after Charles Dow's death, the closing bell rings on the New York Stock Exchange. The Dow Jones Industrial Average finishes at 44,910.65, a number that would have seemed incomprehensible to its creator, but one that follows mathematical principles he established with extraordinary precision. Tonight, as markets close, 3.2 billion people check that number on their phones. Retirement accounts worth $35 trillion adjust their values based on Dow's calculations. Central banks in 190 countries use his analytical framework to make decisions that affect global economic policy. The mathematical DNA he created has become the genetic code for modern capitalism. But here's what would have amazed Dow most. His 19th century innovation remains completely relevant in an era of quantum computing, artificial intelligence, and instantaneous global communication. The fundamental insights he developed about market behavior, investor psychology, and mathematical measurement have proven more durable than any technology built around them. You see, Dow understood something that transcends technology. Human nature drives market behavior, and human nature follows mathematical patterns that can be measured regardless of how sophisticated the trading systems become. Fear, greed, optimism, and pessimism create market cycles that look exactly the same, whether they're generated by telegraph operators or computer algorithms. The Dow Jones Industrial Average today tracks Apple, Microsoft, Amazon, and companies that didn't exist when Dow was alive. But the mathematical relationships between these stocks follow the same patterns he identified in railroad and steel companies 130 years ago. Technology changes. Market psychology remains constant. Here's what's fascinating. Modern financial scientists have spent decades trying to develop more sophisticated market measurement systems using advanced mathematics, computer modeling, and artificial intelligence. Yet none of these innovations has replaced Dow's simple averaging methodology as the primary tool for understanding market behavior. The reason isn't nostalgia or tradition, it's mathematical elegance. Dow discovered that the most complex market phenomena could be understood through surprisingly simple calculations. Adding stock prices and dividing by the number of companies captures market reality more accurately than elaborate statistical models that try to account for thousands of variables. This elegance has made Dow's framework adaptable to changes that would have destroyed more complex systems. When companies split their stocks, when new technologies emerge, when economic structures shift dramatically, the basic mathematical principles remain valid because they're based on fundamental rather than superficial market characteristics. Look, this adaptability has been tested repeatedly. The Dow Jones Industrial Average survived the 1929 crash, the Great Depression, World War II, the 1970s oil crisis, the 1980s savings and loan crisis, the 1990s tech bubble, the 2008 financial crisis, and the 2020 pandemic crash. Each crisis challenged different aspects of market structure, but none invalidated the mathematical framework Dow created. The democratic principles he established have proven equally durable. Despite repeated attempts by financial institutions to recreate information monopolies, ordinary investors today have better access to analytical tools than Wall Street professionals had during Dow's lifetime. Free trading platforms, index funds, and educational resources have democratized wealth-building opportunities in ways that fulfill his original vision. But the deepest legacy isn't technical, it's philosophical. Dow proved that mathematical truth is more powerful than wealth or political influence when it comes to understanding economic reality. This insight revolutionized not just financial markets, but the broader relationship between information and democratic governance. I mean, think about what Dow's career demonstrated. A working-class farm boy with no formal education, no capital, and no political connections challenged the most powerful financial institutions in America and won. He didn't win through violence, legislation, or political organizing. He won through mathematical accuracy that couldn't be corrupted or suppressed. This victory established a principle that extends far beyond financial markets. In democratic societies, accurate information must be publicly accessible regardless of who profits from ignorance or confusion. Whether the issue is climate science, public health, economic policy, or investment analysis. Democracy requires transparent analytical tools that citizens can understand and verify. Dow's mathematical methodology became a model for democratic information systems in other fields. Scientific research, government statistics, and academic analysis all adopted principles of transparency and verifiability that protect objective truth from political or commercial manipulation. The ongoing battles over misinformation, media bias, and expert credibility all trace back to conflicts Dow identified between democratic and aristocratic approaches to information control. His career provides a blueprint for defending analytical integrity against powerful interests that benefit from public confusion. Yet the challenges facing democratic information systems have become more sophisticated. Modern technology allows misinformation to spread faster than corrections, creates filter bubbles that isolate people from challenging data, and enables manipulation techniques that are difficult for ordinary citizens to detect. But Dow's core insights remain valid. Mathematical frameworks that are transparent, verifiable, and accessible provide the best protection against information manipulation. When analytical methods can be understood and reproduced by independent researchers, they resist corruption regardless of how powerful the interests seeking to distort them. The future of democratic capitalism depends on maintaining the principles Dow established: public access to accurate information, transparent analytical methodology, and institutional structures that resist capture by wealthy interests. These aren't just financial principles. They're requirements for democratic governance in any complex society. Charles Dow's greatest achievement wasn't creating useful investment tools. It was proving that ordinary people could understand complex systems when given access to accurate information and appropriate analytical frameworks. This proof revolutionized the relationship between expertise and democracy in ways that continue to shape modern society. His mathematical innovation accidentally became a weapon for defending democratic institutions against aristocratic capture. The same principles that protected ordinary investors from Wall Street manipulation can protect ordinary citizens from political and economic manipulation by any powerful elite. Today, as you check the Dow Jones Industrial Average on your phone, you're using more than just a stock market measurement. You're accessing the mathematical foundation of democratic capitalism, created by a farm boy who believed that truth was more powerful than money, and that ordinary people deserved the same analytical tools as the wealthy elite. That belief changed the world. And in an era of increasing inequality and concentrated power, Charles Dow's democratic revolution remains as relevant today as it was 150 years ago. The numbers don't lie. They never have. They never will. So we've seen how a broke farm boy from Connecticut accidentally created the mathematical language that modern capitalism uses to measure itself. Charles Dow didn't set out to revolutionize global finance. He just wanted accurate information in a world built on profitable lies. But sometimes the most profound revolutions happen when someone simply refuses to accept that things have to work the way they've always worked. When you step back and look at the full picture, Dow's story reveals something extraordinary about the relationship between information and power in democratic societies. Every major challenge he faced, from Wall Street's coordinated attacks to academic criticism of his mathematical methods, was fundamentally about who gets to control the truth in a system where truth affects how wealth is distributed. Today, 150 years later, we're fighting the same battles in new forms. Social media algorithms control what information billions of people see. Financial institutions use artificial intelligence to make trading decisions faster than human oversight can monitor. Cryptocurrency markets operate outside traditional regulatory frameworks. Technology has changed, but the fundamental tension between democratic and aristocratic approaches to information control remains exactly the same. Here's what's remarkable. The principles Dow established for protecting analytical integrity against powerful interests are just as relevant for algorithm-driven markets as they were for handwritten price sheets. Transparency, verifiability, and public access remain the best defenses against information manipulation, regardless of how sophisticated the technology becomes. But Dow's legacy goes far beyond just financial markets. He proved that mathematical frameworks could democratize access to complex analytical capabilities that were previously available only to wealthy elites. This insight has revolutionized everything from scientific research to government statistics to educational resources. The real lesson here isn't that one determined individual can change the world. It's that accurate information is more powerful than money when it comes to protecting democratic institutions. Dow's mathematical tools succeeded because they worked better than existing alternatives, not because he had superior resources or political connections. Whether we like it or not, we're living in Charles Dow's world. Every time you check your retirement account, use an index fund, or read about economic policy decisions, you're interacting with systems that trace directly back to his analytical innovations. The mathematical DNA he created has become embedded in how modern civilization organizes economic relationships. Yet the democratic principles he fought for remain under constant threat from powerful interests that benefit from information inequality. The technology changes, but the fundamental conflict between transparency and manipulation continues in every generation. So the question remains, will we maintain the democratic access to accurate information that Dow established, or will we allow new forms of information monopoly to recreate the aristocratic control systems he spent his life fighting? The answer depends on whether enough people understand that mathematical truth is more powerful than wealth or political influence when it comes to defending democratic institutions. Charles Dow's revolution is incomplete, but unstoppable, as long as we remember what he was really fighting for. Thanks for watching, and remember, every number tells a story if you know how to read it.